Welcome to the Money Wallet Show. My name is Rob, and today we're going to discuss what to do with our investments. Should we stay put? Do we take the money out? Do we invest any fresh money that we have? Given that 2022 has turned out to be a horrible year for investments, it doesn't matter what day it is, it seems like the stock market just keeps tumbling, going down. You're losing money. What do we do? Do we just stay put? What do we do?
Jim, where do you go? I mean, does this pull investors to the fixed income markets? You know, we pointed out a number of times, and it's important to do so. This has been a terrible year, not just for stocks, but for people in bond funds as well, given the move you're looking at right there and what that's obviously done to the prices. But does this yield, let's call it 4% on a 2-year, and the 10-year even above 3.5, well above now, pull money there that otherwise might end up in the equity market?
When someone sits down with a financial advisor and says, what should I buy? I think what they say is, look, let's park it in the 2-year. Let's figure out what the Fed's going to do. I mean, Carl, the Fed at this point, let's say they take it to 75 basis points. Well, that piece of paper is going to go down. In other words, the yield's going to go still higher. So I just think it's something to watch because it's just so competitive.
We just heard Jim Cramer talk about buying 2-year treasuries and call it a day. Why? Because currently 2-year treasuries are sitting at 3.96%. Pretty good. So basically, do we just buy 2-year treasuries and call it a day, wait around for 2 years and wait and see what happens once inflation comes down? What should we do? Before we start thinking about investing our money, we need to find out how are we doing financially. Are we financially secured? What do we mean by that? If our monthly income is about $6,000 from our job, our interest income, dividend income that we receive, perhaps Social Security, any other income that you receive, let's say that it's around $6,000 a month, but your expenses are also $6,000 a month. That doesn't leave you very much or any room to make up for any savings. So basically, you're not saving any money. You're basically living paycheck to paycheck. So your monthly expenses have to be lower than your monthly income. So if that is the case, then you need to make sure that you set up an emergency fund. So don't invest this money. This money needs to be in a secure account, either in a savings account or a CD, 3-4 month CD. Perhaps you can even buy a 1-year treasury securities with not all of the money, but maybe some of the money. Why treasuries? Because it is protected, especially now that the yields are really high, about 4%. Then you can actually buy a treasury bill for 1 year, and it's like a CD. Uh, Once the treasury bill matures for 1 year, then you get your money back plus the interest. But again, this has to be in a safe account. You don't use automobile insurance. You pay it year after year. Perhaps 15, 20 years have gone by and you've never used the automobile insurance. But you don't say to yourself, well, I don't need automobile insurance. Why am I going to pay for it this year? No, you still pay it. Why? Because if you need it, it is there for you. Same thing with the emergency fund. If you have a 6-month emergency fund, it's going to be there to protect you. Let's say that you get laid off from your job, and especially now that we're talking about a looming recession, if that comes into play, you're going to be glad that you have this emergency fund set up because at least 6 months you're going to have funds there to pay for all of your monthly expenses. So make sure that you do that. Emergency fund, that is something that needs to be in your vocabulary before you start investing money. Okay, how about if you have credit card debt? Let's say that you owe $3,000 on your credit card, and right now, the average interest rate for credit cards is about 15.13 according to Wallet Hub. So if that is the case, your credit card may be charging you a higher interest rate, maybe a lower interest rate, but let's assume that it's 15.13. So you have $3,000 in credit card debt at 15.13%. And let's say that you are only sending $45 as your minimum payment to pay off the $3,000. Did you know that it's going to take you 12 years and 3 months to pay off the balance? And you're going to be paying a total of $3,594.25 in just interest. So you're basically paying the $3,000 that you owe to the credit card company plus another $3,594 in interest. So you're actually paying more interest than what you owe, the balance that you owe on the credit card. So the best thing to do is if you have money, don't invest it in the stock market because as we're going to see very soon, or as you already know, the stock market is down substantially. And you're investing, this is 15.13 that you're already making yourself. This is guaranteed that you're going to be making for yourself, as opposed to negative interest rates or interest that you're going to be receiving, or returns that you're going to be receiving from the stock market. So do yourself a favor and pay off any credit card debt that you have. You're going to be glad you did. Okay, how about if you have credit card debt? Let's say that you owe 3,000 that you have. You're going to be glad you did. All right, so you've already set up your emergency fund. You don't have any credit card debt. All of that's paid off, which is great news. Excellent. So now, what if you've already invested into the Vanguard 500 Index Fund ETF? This is a widely held ETF, and currently for 2022 year to date, it is down 19.28%. If you're also invested in small cap ETFs, such as the Russell 2000 index, you're also down 21.34%. And if you said to yourself, well, you know what, at the beginning of 2022, I'm going to invest also in the bond market because that's very stable. Prices hardly ever come down. Well, think again. You're down year to date 13.58%. So no matter where you look, you're down. So what do we do then? Do we sell? Do we buy more? What do we do? Here's the thing, folks. If you don't need the money, leave it there. Don't do anything. The best thing to do is not to panic. You're there for the long run. Don't do anything. It'll come back. As a matter of fact, if you have money, and as I said before, you already have your emergency fund, credit cards paid off, your car is paid off, you don't have any debt, you don't have any student loan, and you still have some money, this is the best time to start dollar cost averaging into your investments. What is dollar cost averaging? Well, that's a fancy term basically to invest the same amount of money over a specific period. Say, for example, you invest, say, $100, $500, $1,000 every week or every month. If you start investing, say, $500 every month on the first, and you do that consistently for the next couple of years, guess what? Then you're dollar cost averaging. All right, this is what I want to show you. This is why you need to be invested all the time. Let's say that you started investing in 2013, and this year is 2022, obviously. So 10 years ago, you invested $10,000, and then you had two choices. One choice was to invest your money, the $10,000, into a three-fund portfolio, the ones that we've been going over, the Vanguard Index 500, the Russell 2000, and the total bond market, Vanguard total bond market. All right, those three funds. So let's say that you put in 65% of your money into the Vanguard 500 index, 20% of your portfolio went into the Russell 2000 index, and 15% went into the total bond fund, the Vanguard total bond fund. All right, so that makes up 100% of your portfolio. The other, another person said, well, you know what? I don't want anything to do with the stock market because that goes up and down and I'm going to be losing money. So, what am I going to do? I'm going to invest 100% of my money into cash. Basically, they just decided to go to a brick and mortar bank and deposited their money into a savings account. So, let's see which of the two portfolios did which one did better, portfolio one that invested in the stock market versus portfolio two, which was 100% in all cash. Let's see how we did, folks. Here we go. Here's your portfolio one, Vanguard S&P 500 ETF, 65%, iShares Russell 2000, 20%, and total bond market, 15%. Portfolio two is all cash. Basically, this is sitting in a savings account, 100%. All right, so let's see how we did here. This is where we started back in 2013. We started with $10,000. And as we move forward to 2014, now we're at 12,848 for portfolio one, which is where we have the stocks, and the all cash portfolio two is sitting at $10,005. Let's move forward to 2022, even with the decline in the stock market that we've seen this year. How are we doing so far from 2013 all the way through 2022? As you can see, portfolio one with the stocks, we would have a total of 27,165. Portfolio two, which is in all cash, we only have 10,659. So we are way behind as far as getting our really good return from those investments. Why? Because we said the stock market is very volatile and I don't want to lose money. Well, guess what? You're already losing money because your account balance in 10 years is only $659 more than what you started with. And here, let's throw a monkey wrench on this. Let's say, okay, that's fine, but we're not taking into account inflation. Inflation has been running rampant in 2022. So show me how the investments would do if we take into account inflation. Okay, so we're adjusting for inflation, and here we are, folks. So your $10,000 that are in the bank are now worth $8,263 now with adjusted for inflation because obviously it costs more to buy things from gasoline all the way to mortgage, everything has gone up. So the 10,000 in the bank can now purchase only $8,263 worth of goods, whereas our portfolio one, which was invested in the stock market with those three funds, now we can buy $21,059 worth of goods. So you tell me which investment is doing better, even with all the volatility. If we put our money into a bank account, are we really saving money? Or I shouldn't say saving money, but are we losing money? And the answer is yes. Okay, we're not losing money by investing the money into the stock market. Look, we're actually gaining money, we're receiving additional money. Whereas if we only have it in a bank account, we're actually losing money. We're behind the eight ball here, folks. So this is what I wanted to show you, that you may think that you're actually safe by putting the money that you don't need into the bank and not investing it in the stock market because it's very volatile and loses money. Well, here's the proof right here. You would actually, your $10,000 back in 2013 would be worth $21,059 adjusted for inflation, whereas your $10,000 can only buy you $8,263. So that's what I wanted to show you. All right, hope you have enjoyed the show. Any comments that you have, please send them to me. Subscribe to the channel. Let me know of any questions that you may have. How are you feeling in this environment where the stock market is tumbling? And tell me what you're investing in. So keep the comments coming. Also, if you enjoy the show, please hit the like button so that others may benefit from this content. And don't forget to subscribe. See you on the next one.